Greetings. This is tutorial sheet 7, question 1. Unibank Limited has 4 investment projects with the following costs and expected rates of return. All projects are independent of each other. So here's our table with that information. The firm estimates that it can issue debt at a before tax cost of 12% and its tax rate is 25%. It can also issue preferred stock at $50 per share, which pays a constant dividend of $6 per share per year. Unibank stock currently sells for $40 per share. The next year's dividend is expected to be $4.50, which is D1, and is expected to grow at a constant rate of 7%. The company's capital structure consists of 70% common stock, 15% debt, and 15% preferred stock. What is the cost of each of the capital components? What is the WACC? If all the projects are of average risk, which should the firm select? We now turn over to Mario Scarlett, John Anthony Latibodiere, and Ryan Fuller for their take on this question.
Okay, good day, sir. So myself, Mario Scarlett, John Anthony Latibodiere, and Ryan Fuller will be doing tutorial 7, question 1. So we're given a table with some details, and the question is: the firm estimates that it can issue debt at a before tax cost of 12%, and its tax rate is 25%. You can also issue preferred stock at $50 per share, which pays a constant dividend of $6 per year. Unibank stock currently sells for $40 per share. The next year's dividend is expected to be $4.50 and is expected to grow at a constant rate of 7%. The company's capital structure consists of 70% common stock, 15% debt, and 15% preferred stock. So we move on to number 1, which I will be doing. So we'll be using the ordinary share formula for this number 1 question here. So we're given these figures here: dividend, price, and the growth in percentage, which is changed over into decimals. And we're going to simply put those figures into the formula. And the formula is as such. So after inputting these figures into the respective areas in the formula, so the price, the growth, and the dividend, we get a value of 18.25%. So this represents the cost of preferred stock. So we'll now move on to part 2.
Alright, so for the WACC, we have the debt, which is 15%, times by the after tax, which is 0.09, plus the weighted preferred equity, which is 0.15, times the cost of preferred equity, which is 0.12, times the weighted of common stock, which is 0.70, times the after tax, which is 0.1825, and that gave us a total of 15.93. So the 15.93 represents the WACC. And we now move on to number 3.
Okay, great. All right. So the company of 4 project, project A, B, C, and D, and it also showed their rated of return. Yes, and it also showed their rate of return. However, the company should just selected project ZD because it does not exceed the WAAC capital for the UN Bank Limited, right? Because it have exceeded all of the 3 project, which is a 15.2, 12.4, and 11.75. But project ZD is 16.5. All right, so that's it.
Thank you, Mario, John Anthony, and Ryan. We will now turn over to Jason Harris, Kirk Blake, and Sarah Salmon, and they will give us their take on the question.
All right, so I'm recording now.
Good afternoon, everyone. My name is Sarah Salmon, and my fellow group members are Kurt Blake and Jason Harris. This evening, we will be presenting question 1 on tutorial sheet 7. And it states, Unibank has 4 investment projects with the following cost and expected rates of return. All projects are independent of each other. So we have project ZA, cost is 12,000, rate of return is 15.20%. We have project ZB, cost is 13,000, rate of return is 12.40%. Project ZC, cost is 15,000, rate of return is 11.75%, and project ZD, cost is 12,000, and rate of return is 16.5%. The firm estimates that it can issue debt at a before tax cost of 12%, and its tax rate is 25%. It can also issue preferred stock at $50 per share, which pays a constant dividend of $6 per year. Unibank stock currently sells for $40 per share. The next year's dividend is expected to be $4.50 and is expected to grow at a constant rate of 7%. The company's capital structure consists of 70% common stock, 15% debt, and 15% preferred stock. I'll now hand over to Kirk.
Okay, so I'll be doing part I, which is the first part of the question, which states, what is the cost of each of the capital components? So firstly, we found the cost of common stock, KS. The formula is KS equals D1 divided by P0 plus G. That equals 4.5 or 4.50 divided by 40 plus 0.07, which equals to 0.1125 plus 0.7, which equals to 0.1825 or 18.25%. Next is the cost of preferred shares, and that is DP over PP, which equals to 6 divided by 50 or 12%. Lastly, the cost of debt, which equals to K dot equaling to KD, open bracket 1 minus the tax rate, which is 0.12 minus 1 by 0.25, which equals to 9%. I'll be turning over to Jason and he'll be doing the work.
All right, good evening, class. Again, my name is Jason. So like Kirk rightly said, I'll be doing the work. So the work formula is the weight or proportion of debt times the before tax cost of debt, open bracket 1 minus the tax rate plus the weight or proportion of preferred equity and the cost of preferred equity plus the weight of relative amount of common equity plus the cost of common stock. And that equals to 0.15 open bracket 0.09 plus 0.015 open bracket 0.12 plus 0.70 open bracket 0.1825. And the work equal to 0.0135 plus 0.018 plus 0.1277. And it gives a total of 0.15925, and that equals to 15.93%. And that concludes the answer for the work. I now present the last question to Sarah.
Good evening again, everyone. So the final question states, if all the projects are of average risk, which the firm select? All right, and so our answer is project ZD should be accepted. Why? Because its rate of return, which is 16.5%, is higher than the cost per walk, which is 15.93%, right? So you want your rate of return to be higher than your weighted average. And so project ZD should be selected. That concludes our presentation for this evening. Thank you.
Thank you, Jason, Kirk, and Sarah. As usual, I'm going to put my spin on the question. So the first question asks, what is the cost of each of the capital components? So we know that the capital components are debt, preferred stock, and common stock. So let's look at the first one, debt. So the question indicates that we can raise the cost of debt before tax is 12%. The tax rate is 25%. So based on that, we know that the cost of debt after tax is equal to the cost of debt before tax multiplied by 1 minus the tax rate. So here we have it, 12% times 1 minus that, and crunch numbers, 9%. So our cost of debt after tax is 9%. Let's now move on to our preferred stock. Right, so our preferred stock, the price is $50 and the dividend is $6. And we should know that the cost of preferred stock is simply the dividend divided by the price. So we do that and we have our cost 12%. Right? The only exception here can be when we are issuing new preferred stock and there's a flotation cost. So when we have a flotation cost, we have to subtract the flotation cost from the price before we divide. So we would actually have the dividend divided by the net price. All right, let's move on to common stock. Our common stock price, $40. The dividend next year, D1, is $4.50, and the constant growth rate is 7%. So we have everything we need. We can jump right in, and we have the price is equal to D1 over P0 plus G. So we have $4.50 divided by $40 plus the growth rate 7%. And all of this works out to 18.25%. Right? The second part of the question asks what is the WACC. And in addition to the three, we calculated the cost of debt after tax, the cost of preferred stock, and the cost of common stock. Now, in addition to those three, all we need are the weights. And we have the weight of common stock is 70%, the weight of debt 15%, and the weight of preferred stock 15%. So here goes. The WACC is equal to the weight of debt times the weight of debt after times the cost of debt after tax, plus the weight of preferred stock times the cost of preferred stock, plus the weight of common stock times the cost of common stock. We have all of those numbers, so we drop them in. All right, and crunch the numbers, and here we have it, 15.925%. So our WACC is 15.925%. The final part of the question asks, what is the, if all the projects are of average risk, which should the firm select? Now, important to remember, the WACC is our hurdle rate, right? So all projects must exceed the WACC before we can accept them, right? They must be able to climb over this hurdle rate. So the WACC is 15.925%. So let's look at the projects. Project ZA, 15.2. No, it doesn't make it. So, no to project ZA. Project ZB, 12.4. Not climbing over the hurdle rate. Project ZC, 11.75. No, not meeting the hurdle rate. Project ZD, 16.5. Yeah, this one exceeds our hurdle rate. So we go ahead with Project ZD, since 16.5 is above our WACC of 15.925%. So only Project ZD should be accepted. All right, thank you guys. All the best going forward. Please put in the work. Exam is 2 days away. All right, put in the work. Tuesday morning, 9 o'clock, you should all be ready and rearing to go. All right, and remember to practice answering your questions in Blackboard. All right, all the best. Talk soon.